What I have done with Chapter 1 is I've divided it up into three segments. The first segment will look at the basic vocabulary for accounting, some of the basic vocabulary. We'll look at what accounting is, why it's important. The next mini lecture, if you will be on transactional analysis. And then the third one will be on financial statements. All right, so I'm going to go to the next slide. Next slide explains the three basic activities of accounting. Identifies. First of all, we're identifying transactions, whether it be a sale, purchase of equipment, payment of salaries expense. Once those transactions have been identified, then it is important for the accountant to determine what accounts will be affected by the transaction. Once that's been determined, then those transactions will be recorded in the accounting records. And when we get into Chapter 2, we'll look at how the transactions are recorded in the general journal. Once the transactions have been recorded and summarized, and we'll look at summarization in Chapter 2, then the financial statements are prepared. So that's the whole point of this whole accounting cycle. Those financial statements communicate the financial condition and the profitability of the organization, and plus we'll touch a little bit on cash flow. It will also enable the user to look at the sources of cash flow for a business and then the uses. So what we have here is we have a diagram of what I just said, where you have identification of transactions, the recording, and if you notice it says recording, classifying, and summarizing. So that involves the general ledger and the general journal and the general ledger or the T accounts. And then ultimately the preparation of the financial statements, which are used by specific users to make decisions. And later on we'll talk about the different users, or actually I'm going to leave that to you in a discussion board. Alright, so these are some general examples of internal users of financial statements within the organization. Then we have external users. You can go back and read this on your own. This slide for external users is very general. When you go into the discussion board, I will be looking for more specifics because there are other users as well. Alright, as you may recall, there were a number of major frauds committed by top management of such organizations as Enron, WorldCom, Health South, and AIG, and there are other companies. What that did was, in the case of Enron, what happened with Enron, in a nutshell, is that the senior officers came up with a scheme whereby they created these special entities. They took the debt of Enron off Enron's books and put the debt on these special entities. So it made the Enron financial statements look a lot better than they were. The price of the stock skyrocketed. The employees were required to invest in the Enron stock as part of their 401k, which drove up the price. And then the senior officers, once the price got high enough, they sold off their stock. So the stock crashed. The company ended up going out of business. The employees lost their jobs. They lost their retirements. The shareholders and the investors lost a lot of money. And not only did Enron close up and all their employees lose their jobs, but also the businesses that relied on Enron. So that in 2002, Congress passed the Sarbanes-Oxley Act. And among other things, it required that the senior officers of an entity must personally sign off on the financial statements saying that they are accurate, and that should there be a fraud uncovered, they would be held personally and criminally liable. It also required that they have strong internal control systems that are constantly reevaluated to make sure that they are working as they should be to help ensure the accuracy of the financial statements. All right, so we come to the question of ethics. And of course, if we consider what we mean by ethics, of course, it's what we consider right or wrong. And our personal ethics may have some variation. Organizations may vary in terms of their ethical code, as well as different countries. All right. So now, in the first part, we have to recognize an ethical situation and the ethical issues involved. So, as an individual, you have to consider your own personal ethics and determine whether or not a situation you find yourself in, whether or not there are ethical issues. Organizations, whether they be businesses, colleges, not-for-profits, hospitals, do have written codes of ethics that employees can use as guidelines in making decisions. Right, the next step, the next part is to identify and analyze the principal elements in the situation. So in other words, to identify the stakeholders, those persons or entities or groups that would be harmed by an unethical action. All right, so organizations, individuals have responsibilities to stakeholders. Third part, identify the alternatives and weigh the impact of each alternative on various stakeholders. So the ultimate goal is to select the most ethical alternative. Sometimes it will be clear cut. There will be one right answer. Other times, and most times, you're going to run into a gray area in which you're going to have to weigh your alternatives and choose the one that serves the greater good or does the least harm. In preparing the financial statements and also the whole accounting cycle, the basis for that are the generally accepted accounting principles. They are broad guidelines used by accountants to record, to summarize, and to report on the financial transactions of an entity. Going to consider the historical cost principle. This is a major principle that is part of the generally accepted accounting principle. So according to the historical cost principle, the assets that are acquired by a company must be recorded in the accounting records at acquisition cost. And according to this principle, that there should be no adjustment for changes in fair market value. However, that has been something that has been debated for a long time in the accounting profession. So now we have the fair value principle, and that states that assets and liabilities should be reported at their fair value. So in other words, the price received to sell an asset or to settle a liability. But here's the challenge. According to the historical cost principle, the only way that you'd be able to determine fair market value would be to actually sell the asset. However, on the other hand, you may have a company that has had, let's say, real estate for decades. That's recorded at cost, but the fair market value has increased. So now what do you do? So as the slide points out, we have trade-offs: relevance versus faithful representation. So a decision has to be made here. Is the fair market value for in a particular situation more relevant than historical cost? Couple of other general principles. Monetary unit assumption. Regardless of our backgrounds, whether we're accountants, whether we're rocket scientists, whether we're marketing people, we all understand money. So that money is the universal language. It's something that we can all relate to. So therefore, all transactions are recorded in terms of money, and therefore all financial statements are prepared in terms of money. All right, the economic entity assumption, or the economic entity concept. First of all, we need to define what we mean by an economic entity. An economic entity is a separate unit that engages in distinct activities, and that each economic unit or each economic entity must maintain its own accounting records and prepare its own financial statements. So a lot of large corporations are comprised of several economic entities. Some examples: General Electric, Disney. So within those large entities, there are several entities, and they must prepare their own financial statements. And then what we see in the annual reports are we see consolidated financial statements, where the financial statements for each economic entity that makes up GE or Disney are rolled up into one set of financial statements. Now, under the economic entity assumption, they talk about 3 different types of business structures. But what I'm going to do is I'm going to go to the next slide where they give us a better presentation of that. All right, so we have a proprietorship or a sole proprietorship. It's owned by one person, and that the business cannot exist apart from that person. And also, it's the easiest type of business structure to form. However, the downside is that the owner is personally liable for the debts of the business and any lawsuits against the business. So in other words, the owner's personal assets are at risk. Also, the sole proprietorship is not a taxable entity, that the taxable income of the sole proprietorship is reported on the tax return of the owner and is taxed at the individual rate. Then we have the partnership. Partnership shares some similarities with the sole proprietorship. So now we have 2 or more persons who own the business, and they run it with the intent, of course, of generating a profit. Once again, there is general unlimited personal liability, so that each partner is personally liable for the debt of the business, and also for any lawsuits, and their personal assets would be exposed. There should be a partnership agreement which would lay out this particular duties and responsibilities of each partner. Also, it would indicate how profits and losses should be distributed among the partners. It should lay out the procedure for admitting a new partner, or procedures for when a partner may leave the partnership. Each time there is a change, whether it be a new partner coming in or one leaving, then the original partnership ceases to exist and a new partnership is formed. Also, the partnership also is not a taxable entity, so therefore the proportional share of net income or net loss is shown by each partner on his or her personal tax return. Now we have the corporation, and the corporation is going to be the focus of this course. So a corporation is a separate legal entity. It has an unlimited life apart from its owners, and of course you know the owners are the shareholders. We also know that corporations' stock is traded on a secondary market. So after the initial public offering, can then go to the secondary market where the ownership is constantly changing. The corporation is considered an artificial person that can be taxed and can be sued. The owners, as in the stockholders, have limited liability. So, if we own stock in, let's say, Disney, and they get sued, major lawsuit, the most that you and I could lose would be our investment in Disney. That the plaintiffs could not come after us and confiscate our houses or bank accounts or what have you. The corporation has an unlimited life as long as it's a going concern. So if you think about General Electric or you think about IBM, those organizations have well outlived their founders. All right, so that's all there is for the first third of this lecture. And I'm going to end each lecture with the photograph. I'm into photography, so you will see different photographs. What I'm going to show you is one on Boston. All right, and then we will go on to the next video.